Hello and welcome. My name is Connor Marsh, and I'm with Excalibur Financial Services. We are a Jacksonville, Florida-based money management firm whose founder, Gary Marsh, has been in the business for over 35 years. Today we'll be looking at the 2018 year-end economic update. Most of the data today is being provided by our friends at JP Morgan Asset Management. We always find the information they provide to be very valuable and informative. This is the report we'll be looking at today. It is as of December 31st, 2018. If you've seen any other videos we posted to our site, this will look very familiar to you. This report is basically a snapshot of recent market activity. Here we can see a breakout of the major equity market indexes, both domestic and international. As you know, there's been quite a bit more market volatility, especially in Q4 of 2018. We can see that evidenced here by the quarter to date column. For much of this year, U.S. markets had performed relatively well, but talks of trade tariffs, the Fed continued rate hiking, and some concerns the U.S. recovery is getting a little bit long have likely been the root cause behind the volatility we have seen in Q4 of this year. This has dragged down major indexes down into the negative territory. As we can see on these year-to-date numbers, we have the S&P 500 down just over 5%. Our international index here down 13, and emerging markets down 14.5. So the defensive adjustments Excalibur made to our managed investment accounts earlier in the year have really proven to be timely. Here we can see the different sectors of the S&P 500 broken out. Looking down towards the bottom, we can see, to no surprise, utilities is one of the top performers and is actually positive for the year. Utilities tend to do well in times of high volatility and are considered a defensive equity due to their high dividend payments. If you think about in times of low economic growth, when consumer confidence is low, many won't go out and purchase a new car or a new home. You still need to pay the bills, you still need to keep the lights on and the AC running. So for that reason, again, utilities are just a little bit more of a defensive stock or equity. Look down towards the right, we can see materials, one of the worst performers, likely due to the tariff talks between China, the U.S., and other countries. Materials mainly hitting on aluminum and steel and things of that nature. Companies like Caterpillar and other large manufacturing companies tend to be hit by these kinds of discussions, and they're affected most. Another one we'll look at is energy, which is actually the worst performing year to date, and we'll look a little bit closer at that on the next slide. So here we can see some commodities, and we'll mainly be focusing on oil. We can see that oil prices have fallen significantly from a year ago. Around this time in 2017, they're around $60 a barrel, and then as of this past week, they're right around $45 a barrel. And if we look even on a more condensed time frame, just the beginning of this quarter, so the beginning of September, or I guess October rather, the oil prices were around $76 a barrel, and now they're around $45. So it's a pretty steep drop. Although this hurts energy companies, the drop in oil prices will cause gas prices to drop. And again, this discount in prices in fuel prices can be seen as kind of a mini tax cut. People will save at the pump and likely spend those extra dollars in other areas to provide the economy a little bit of a stimulus. Switching gears a bit, we'll look at fixed income now. Bonds tend to face a little bit of a headwind in a rising interest rate market. So we can see on a year-to-date basis, bonds were relatively flat, with the aggregate losing just 23 basis points here, and corporates losing around 2.75%, and municipals returning just around 1.5%. The fixed income area is an area we allocated some additional dollars to in the portfolios this year as part of our defensive adjustments. As you know, this area provides a lot of the downside protection in the portfolio, and really helps in times like these. Overall, we feel the volatility we've seen, especially in Q4 of this year, is driven by emotion and momentum investing rather than hard economic or corporate data. Earnings reports and economic data are still being reported as relatively strong. So in light of these lackluster returns of these indexes, there are some positives to look at moving into 2019. The drop in oil prices, as I mentioned, will provide a small stimulus to the economy in the form of lower gas prices. Companies like MasterCard have released data estimating this year's holiday sales were some of the best numbers they've seen in a while, some of the best in 5 years actually. This would indicate consumer spending and consumer confidence is high. And also, we are expecting job growth to continue to chug along at a steady pace. We anticipate the unemployment rate to either stay at 3.7%, which happens to be the lowest since 1969, or possibly drop to 3.6%. So that was our year-end economic update. We hope you found this information to be helpful. Again, my name is Connor Marsh, and I'm with Excalibur Financial. Please feel free to reach out with any questions you have about today's video or any other financial related questions you may have. Our number is 904-619-5944, or you may contact us through our website, excaliburfs.com, seen at the bottom of this slide here. Thank you, and wish everyone a great 2019.